Okay, okay. The recording has started, and we have how many of us are here? Like 10, right? We have 10 people, and of course, let me briefly check how many are in the. There's like 13, so 12, but except myself. So let me share a screen. All righty, so here, I believe everyone is fully aware that you need to do the attendance report, right? You need to do the attendance reporting in the discussion board. Sometimes some people forget to do that, but this is the first thing you must do. This is the first thing you must do. If you don't find your name here, right? Currently, I see 12 because one is me, right? So let me try again. Yeah. So 12. So there are 12 people here. That means, and there are only 10 here, right? 10. That means 2 people are not in. They signed into the today's forum, but they are not in the collaborate session. So sometimes they are in the collaborate session, but they forgot to sign into the today's forum. But you got to make sure that you have your physical proof of attendance, your digital footprint, and that's what is done. That's taken care of by signing into the discussion board, right? By doing the attendance report. All righty. So I believe everyone knows that. Everyone must have seen that the new announcement has been posted, right? This is the latest announcement. So still, this is the second practice test in ROI. So it's gonna start tomorrow, right? So 180 minute, 3 hour. But it doesn't really take 3 hours. I mean, there are 50 questions. So basically, it will take 50 questions. It will take time, but it's not gonna take 3 hours. I just give you, plenty of time. I'm giving you, ample time. Even if you take, I mean, think about it. If you take 2 minutes per problem, and that would be most likely, enough. 2 minutes for 50 problems, that's 150 minutes, right? So, or it will take actually less than 2 minutes per, 100 minutes. I mean, if you take 2 minutes, 100 minutes. So it doesn't even take 120 minutes. And 2 minutes would be, it doesn't, it's not, you don't see that yet. It's going to be available from tomorrow. It's grayed out. That means, it is not available yet. And I've extended, and there was an email that went out already about this, the display window, the window of display, what should I say? You cannot start, you cannot do it, but you cannot review it, right? And that window is extended to when? I believe, this weekend, because that announcement went out. Right, yeah, ROI concept check display extension. It's going to be until this Sunday. So please go over it. And if you have, uh, as I said, we don't have time to go over it during the collaborate session, but I will be happy to answer. I will be happy to go over it during the Zoom office hour. If you need, if you can't make it during the office hour, you can email me to schedule. Anyway, so we are basically, we talked about, a bond market operation last time, and please watch the original videos, right? Original video lectures, because we just we don't have time to go over everything. So you have to flesh it out, or you have to flesh it out. You add flesh to the things that I haven't been able to that we haven't been able to discuss during the collaborate session. There's no time. So so we move on to the next question. Next topic, right? I mean, next subtopic. So we've been talking about, interest rate, right? Because interest rate is the, if you think about it, it's the baseline, it's the bottom line of all return on investment, meaning that that's risk-free, basically. Interest rate, and when we say interest rate, it means a lot of things. Now, first of all, there's bank interest rate, right? And there is, bond coupon rate, the coupon rate that the bond pays. Basically, whether you put your money in the bank or whether you put your money in the bond, they are all basically a lending, right? They are all, so that means depending on different borrowers, right? The rates will be different, and that's also the same thing as saying, I mean, you understand this, depending on your credit score, you pay different interest rates, right? If you have excellent credit score, you don't have to pay high interest rate. But if you have bad credit score, you have to pay a high interest rate because you are a high risk to them. They will charge. So the lender will get different interest. So turn the table around. If you are the lender, yes, when you put your money in the bank, you're the lender. When you put your money in the bond, when you buy bond, you are the lender. So depending on the borrower's credit rating, the company that has low credit ratings will have to pay higher interest rate, coupon interest rate, to attract the investors, right? To attract the bond buyers, right? To attract the lenders. The company that has high credit rating, safe companies, they don't have to offer high coupon interest because they are, their advantage. They are safe companies. That alone is they are low risk companies, low risk borrowers. That alone is a big advantage that they come into the market with, right? So think about it. Basically, when we say average interest rate in the market or prevailing interest rate in the market, this is a very wide, broad definition. Why? Because you understand that there are many different levels of interest rate, because depending on the default risk of the borrower, and then the safest is basically treasury, right? Return on the treasury, right? And safest is treasury, and also bank interest rate is as safe. CD, interest rate on the CD, is also risk-free. So if you ask me, what are the risk-free interest rates? What are the examples of risk-free interest rate? U.S. Treasury, it goes without saying. Nothing beats the U.S. Treasury in terms of safety. And then because it's risk-free, it's riskless or risk-free. And also CD, interest rate on the CD, that is, of course, risk-free. The return on the savings account, that is risk-free. But return on the savings account is mediocre, so mediocre, right? It's not even like 0.1%. Not so immaterial. There's nothing to talk, but still, that is guaranteed, right? It's risk-free. But the whole point is, what if they are the whole point is, you get 0.1% when you put your money in the bank, in the savings account, but let's say there has been 2% inflation. 2% inflation. Even 1% inflation. Even 1% inflation. Your 0.1% interest is completely wiped out. Isn't that right? This is the problem. Minimum, immaterial interest rate means nothing, because suppose you put your $1 million in a bank. You put $1 million in the bank. So 1 year later, what do you have? If the interest rate is 0.1%, 1 year later, what's in your bank account? Huh? Can anybody tell me? Again, 5-second rule. Okay, if you're silent for 5 seconds, then I will have to give you penalty to everyone.
Did you say 0.01%?
0.1%. Interest rate is 0.1%. So 1 year later, what's
a million and 10,000?
A million and what?
10,000.
Million and 10,000?
You said.
Actually, look, 1 million, 10% of 1 million is 100,000. 1% of 1 million is 10,000. Right? Interest rate is, did I say interest rate is 1%? Huh?
0.1%.
Yeah, then what is it?
1,100,000.
And someone was trying to say what? 1 million and what?
100,000.
No, before you.
1,000, I said 1,000.
Yeah, 1,000. And who was that? Who's that?
Algebraic Nurmatov.
Algebraic. Okay. Of course, look. 1%, it's 1 million. If 1% of 1 million is 100,000, then 0.1% would be, 1/10 of that, right? Just, working. I mean, I'm not even working with any complex numbers. It's just, zeros, just one and so many zeros. And okay, I'll go back. You guys, 0.25. So yeah, 1 year later, you have, okay, let me write this out, because, and where is, This wasn't it. There was something with ROI maybe. And then think about it. If there was 1% inflation during the same time, there was 1% inflation. So I'm gonna now. I talked about this in another class, but look, there's a reason why we have commas, right? Because after every three digits, after every three digits, right? After every three digits, the word changes, right? Because after the first comma, right? The name of the quantity, the name of the number is 1,000, isn't it right? After the first comma, it's 1,000. In other words, 1,000, 10,000, 100,000. All you need to do is just, right? Count the comma. I mean, after the second comma, it's 1 million, of course, right? But then after that, until the next comma, it is 10 million, 100 million, and after the third comma, it's 1 billion. Isn't it right? And then after another comma, right, the fourth comma, right, it's going to be 10 billion, 1 billion, 10 billion, 100 billion, and the next comma, like, fourth comma, right? Then 1 trillion, right? So the unit changes after every comma, right? So if you look, so we were talking about 1 million. So what 1%? Think about it. 1% is 2 zeros down. Then 10,000. 1% is 10,000. 0.1%, 3 zeros down. 3 zeros down. Then it's going to be 1,000, right?
Yes.
Yeah, I mean, if you just keep track of how many commas are there, I mean, it's every three zeros, after every 3 zeros, right? The word changes, right? And then, it's not a difficult thing to figure out that, if R at 0.1%, and this is the assumption that we have been using so far, because that's the reality. In reality, you put what is the interest rate that you get on your savings if you put it in the bank? 0.1%, even less than that, right? That's what I've been telling you all this time. So it was 0.1%, so it's $1,000. But so a future value 1 year later will be $1,001,000, right? But then think about it. What if what if the inflation is 1%? Now that pi, the symbol pi, right? Ask students, what is pi? Some people say 3.14. Yeah, that's pi, of course, mathematically, but pi is also a symbol for inflation. Pi is symbol for inflation in economics, in macroeconomics, right? Well, in microeconomics, pi is a symbol for profit because as they say, I want my piece of pie. I want my piece of pie. I want my slice of pie. That's the pie. Pi, P, Greek character pi is Roman character P, and P is for profit. Okay, so think about it. If inflation is 1%, then means what? 1 year later, 1% of 1 million is what? 1% of 1 million is what? Is it that difficult? We know what
1 million.
1% of 1 million is 1 million?
1,000.
Oh, no. 1,000. 100,000.
10,000.
1,000 is 0.1%. 1,000 is 0.1%.
100,000. 100,000.
10,000.
1,000. 10,000. Okay, who said 10,000?
Safia.
Safia. Okay, Safia. So you get 0.25. Do we have to struggle with these, very simple numbers? I'm not even using, 345 million, 675,000, 725. I'm not using a number like this. I'm using just 1 and zeros. And you cannot even, come up with 1% and 0.1% of just 1 and zeros. That's just, disappointing. It's very disappointing. If you're struggling with just working with just these numbers, that are composed of just 1 and zeros, right? And I'm not even using 7.5% or 13.75%. I'm just saying 1%, 10%, 0.1%, right? If you're struggling with that, something as simple as that, then that's very disappointing, right? This is not even any calculation. It's just logic, simply a logic, straightforward logic. Okay, so then what does 1% inflation mean? That means everything is 1% more expensive. If everything is 1% more expensive, right? The money has lost purchasing power by 1%. So 1% seems, rather. Let's do it. Let's make it 10%. So it will be easier to work with, 1% and 10%. So interest rate is 1%. If interest rate is 1%, it's going to be 1 year later, it's going to be, where is draw? $1 year later, you're going to have $1,010,000, right? But let's say inflation was, so during this 1 year, inflation was 10%. Let me rather do it this way. Then what does it mean? This, although although nominally there's $1,010,000, its purchasing power is 10% less than that. If it is 10% less, what's its actual purchasing power? How do you so this is nominal. Nominally, 1 year later. Now, you should understand the difference between nominal dollar and real dollar. Now, so if you adjust this 1.01 million, right? That's 1.01 million, right? 1.01 million. If you adjust it for inflation, that will be real dollar. How do you do that? How would you adjust it for Now let's do a little thought experiment. If the inflation is 10%, right? Everyone, let's think about it. If inflation is 10%, if Coca-Cola, if a bottle of Coke was so price at time 0, and this is the price of Coke. If bottle of Coke is $1, and if at time, this is really annoying. I'm jumping here. And if there has been 10% inflation, if there has been 10% inflation between time 0 and time 1, right? What should be the price of Coke?
$1.10.
$1.10.
$1.10. Yes, you're right. $1.10. That's not a big deal, right? Everyone, and actually, $1.1, and the inflation is, inflation is, the inflation data is collected. Basically, if you go to Federal Reserve website, you can find inflation data, but it's not. It's around. They say it's around 2%. I mean, it's around 2%. But that's when everything is averaged out. When everything is averaged out, right? But they say if you go to supermarket, if you go for grocery shopping, they will all say, and actually this price of grocery has actually gone up by about 33%, right? Huge, but just because you don't say that, you don't call it inflation. I mean, increase in price of grocery alone, or a particular sector alone, you don't call that inflation. Inflation is basically sustained increase in price level across the entire economy. Sustained increase in price level across the entire economy, right? So just because gas price has gone up by, gas price is also up. Just because gas price is up by 10%, you don't call that inflation. Just by that alone, right? You have to average it out across the entire economy. So you can say the prices of grocery went up by 30%, but you don't call that inflation. Because it has to be across the entire economy, and across the entire economy, it is about 2.5% or so. But let's say it's not a difficult thing to understand that if average, across the economy, on average, price level went up 10%, we can easily tell, oh, price of Coke would be $1.10. Now then, this P1 is simply what?
The price 1 year later.
What's that?
The price a year later. So
Yeah, that's right. But I'm not talking about. Yeah, that's obvious. P0 is price at the initial time. P1 is price at 1 year later. But we don't talk in words. Of course, I'm talking in words, but we don't use words. I can tell you, math is the language. Math is the language, not the words, not the verbiage. Okay, math is the language. We define everything in math. That's science, basically. Okay, economics, finance, physics, right? Physics is natural science. Economics is not natural science. Finance is not natural science, but they share the common ground. The common ground is the math. Math is the language. So you don't say P1 is the.
So P0 plus 5 times.
Huh?
P.
Okay, say that again.
P0
plus.
Plus.
Did you say plus?
Yeah.
Okay, let's try it. Okay,
plus
P0
the
plus.
Parentheses.
Why? If it is plus, why do you put parentheses?
Because then you're gonna multiply to get the actual 10%.
Yeah, multiply where?
Well, if you multiply the price, so P0 again, multiply by 0.10.
Oh, you mean, okay, I see what you're saying. You're saying P0 plus P0 times
Pi.
inflation rate,
Yeah.
pi, right? But then, I've been telling you, you don't say, I go to BMCC, John goes to BMCC, his sister goes to BMCC. You don't say like that. I mean, I go to BMCC and John goes to BMCC and Sally, his sister Sally goes to the BMCC. I've been telling you, that's not a good form. What is the good form? What is the good form?
P
times
P0 times P0 times. Please. This isn't really helping me.
P0 times parentheses 1 plus time.
Yes. You got to factor out the common factor. This has to be part of your, this has to run in your bloodstream. You understand? This has to be your second nature. It must run in your bloodstream.
But with the formula that I gave you, it's the same exact answer.
What?
With the formula that I gave, wouldn't it still get the same exact answer?
Yeah, but this is not the good form. As I said, you can say I go to BMCC and John goes to BMCC, his sister goes to BMCC. Oh, what is that? Redundant, isn't it right? So you factor out the common factor. Common factor is what? Go to BMCC, right? I repeated this over and over so many times. So in the parenthesis, what comes then? John, comma, his sister Sally, and I, and you close parenthesis, go to BMCC. You understand? You factor out the common factor. That's the, of course, when you don't put really parentheses, but in writing, but you minimize the redundancy. You must minimize the redundancy. And that is the good style. That's the good form. In writing class, if you write, I go to BMCC and John goes to BMCC, and his sister Sally goes to BMCC. If you write it like that, you get 0. You understand? It can be more concise, and you must make it concise. And then John, comma, and that comma is called Oxford comma. Oxford comma means and. You don't repeat and. When there are and, repeated and, that's redundant. So John, comma, his sister Sally, and you use and only once at the end. And I. You always put me. You always put the first person in the last place. Why? That's humility, humbleness, right? Modesty, humbleness. You're being humble by putting yourself last. And humility is, modesty and humility is character. It tells, someone who is bragging about, just, I don't like hip hop or rap. Why? Because the minute of course, I'm of different generation, from old school. But the thing is, they always put I first, and they are this, basically, you don't have to put other people down, but, to put yourself up, but those things are always, so what is that? The gesture is almost like a roosters, or turkeys, just, battling each other. They put out the chest and, bump into each other. And it's always, like, I'm the best, you're nothing, I'm the best, you're nothing. That is just, complete lack of humility, complete lack of character, complete, someone who, doesn't see future. You only see, the present, right? Short-sighted, right? By saying, I'm the best, you're nothing, then what's going to happen in the future? You're building up animosity only. You will be surrounding yourself with enemies. You're making enemies, right? But that's the lyrics of the rap, lyrics of the hip hop. That was like, back in the early 1990s and early 2000s, Tupac or whatever. These guys were like, just building up animosity. That's basically short-sightedness. If you see future, if you look ahead, if you put down other people, right? And if you want to if you raise yourself by putting down other people, you're building karma. It's gonna come back to you as the karma, right? Who's gonna like you when you put down the others just to put them to put yourself up? They will. It's a common sense. I know. Nobody would be stupid enough to think that that will really do anything good. But the point is, it was brought up because the reason why I put the first case, why you have to put the first case pronoun in the last place. John comes first, his sister Sally, or that order doesn't matter. But one thing's for sure: the first person, I, must come in the last place. Okay, that's a good style. But anyway, so this is P1. Now you understand this math, and we speak in math. So then, think about it. This is the future value, right? In other words, this is P1, right? Then how would you make adjustment? Let's say, considering this is so in other words, $1,010,000 is only $1,010,000 10,000 in nominal dollars. But think about it. If there was no inflation, how many bottles of Coke can you buy? If there was no inflation, with $1,010,000, how many bottles of Coke can you buy?
1,010,000.
Exactly. 1,010,000. And who was that? Who said that? Huh?
Gabriel.
Okay, Gabriel. So please enunciate your name. Okay, Gabriel. So you got 0.25. Yes, but now, because if there was no inflation, the Coke is $1, so it's easy. But after inflation, how many bottles of Coke can you buy? With this money, with this money, how many Coke can you buy? Well, think about it. All you need to do is divide this number, right? I'm not going to write it again because it takes time. By the price of Coke. Now, the price of Coke is $1.10. If you divide it, that will give you how many bottles? Isn't it right?
Yes.
Yeah, and you can, it doesn't really matter how many, but
Yes.
you can just do it by, I will, okay, using the calculator. That was 1,010,000, right? Divided by 1.1. So 918 bottles. 918 bottles. You cannot buy I'm sorry, 918,181 bottles. Okay, you wanna round it up, but we are talking about bottles. 81% of bottle you can, but roughly 918,182 bottles you can buy. But if you think about it, that's the purchasing power of this nominal dollars. Makes sense? That's the purchasing power of this nominal dollars, right? So, because of inflation, the purchasing power eroded. The purchasing power went down because the inflation eroded the value of nominal dollar amount. And then this is called, so if you can buy only how much was that? 918,000.
918,181.
Yeah, 918,181. Okay, 918,181. 918,182 roughly, right? Approximately. If this is the number of bottles you can buy, right? Then this is actually the real. If this was not, if you didn't divide it by 1.1, but if this was actually, think about it. I mean, this is what 1 plus 10%. This is 1 plus 10%, meaning if you adjust this nominal dollars by 1 plus 10%, right? Because everything is 110% now. Every price of everything is 110%. Isn't it right? Price of Coke went up by 10%, which means it is 110% of what it was a year ago. You understand? Price of Coke is now 110% of what it was a year ago. Does that make sense?
Yes, Professor.
Yeah. So, in other words, you're basically, if you are making adjustment for inflation, then this is the actual purchasing power of this nominal dollars, right? What not $1,010,000 is actually worth today is only $918,182 could buy a year ago. Make sense? In other words, this is called real dollars. Okay? So this is nominal. This future value is nominal if interest rate is 1%. If interest rate is 1%, 1 year later you'll have this. That's nominal future value, right? Or nominal dollars, in nominal dollars. But the future value in real dollars, future value in real dollars is only 918,182. So that means it's only the purchasing power, actual purchasing power of this is only just about as much as this, because that's what it can buy only, right? You can buy only 918,182 Cokes, bottles of Coke. That's it. So making real means after adjusting for inflation. When we say real, that means after adjusting for inflation. And this is how you adjust for inflation. Inflation was 10%, so you divide it by 1.1 because everything is 110% of what it was, right? So think about it. The same thing. In other words, isn't that the opposite process of what this is? I mean, think about it. Coke is now $1.10, and $1.10 is, where does this $1.10 come from? That $1.10, $1.1 came from $1. $1. You know, I don't know if I. Someone said, I believe, I remember, someone said I need a special stylus pen for my computer. I mean, the specific model. I don't know, because I thought I tried this as a tablet. You know, this computer can double as tablet. But if it is tablet, any rubber-tipped, stylus would work on tablet, but somehow it didn't work. So I'm not sure if but I'll have to look. If I buy a stylus that is, that works specifically with my computer model, then if I can use that stylus to so think about it.
Also, you can insert symbols instead of write those.
Yeah. I can do that, of course. But then what's the I will have to be typing in or something. I can do I can open a text box, and in the text box I can type it in. But then I think it's this drawing is not faster than you. But then I cannot make text box has to be in certain. It's fixed in certain place. I cannot make quick jump from place to place. Anyway, so you see, 1 point Coke is now $1.10, and why is it $1.10? Because it grew by 110%. Make sense, right? It grew by 110%. 1.1 is 110%. So if you want to know, if you want to get back to that, so if you want to get back to that, you simply need to divide this by this, then you get back to $1. Just the same idea, right? You have currently 1 year later you have $1,010,000 in your bank account because thanks to 1% interest rate, 1%. But after adjusting for 10% inflation, actually you can tell your purchasing power is lower than $1 million a year ago. Because a year ago, with $1 million, you could buy 1 million bottles of Coke. Now, with even 1.1 million, you can't even buy 1 million bottles, right? So this is, basically how you make adjustment for inflation. Now, think about it. Here's the, we spent 1 hour. Interest rate is also, and you've been seeing me using I for symbol for interest rate, also R as the symbol for interest rate. But then, how are they different? R is, it stands for rate of return, so right. But generally, right? Generally, it's rate of return. But when it is used together with I, that I stands for nominal interest rate, nominal, right? R stands for real interest rate. R stands for real interest rate. Makes sense? R stands for real interest rate. And then, so the difference between nominal interest rate and real interest rate is the inflation, right? So think about it. Now, if inflation, real interest rate is, if real interest rate is 1%, if real interest rate is 1%, and if inflation is 10%, then nominal interest rate should be 11%. Okay, but then the thing is, so nominal interest rate is always, exactly compensated for the inflation. No, that's not what I'm saying. Because nominal interest rate is what you can observe all the time, because you go to the bank and ask them, what is the interest rate on the CD? They will tell you, it's 3%. If they tell you 3%, that's nominal interest rate, of course. But if you ask them, what is the real interest rate? They don't know what to say. Of course, if you ask just the teller, the bank teller at the window, they wouldn't even understand. But if you ask the branch manager or some senior staff who has studied at least economics and finance, they may be able to answer. But then think about it. Who knows what is the inflation rate? You look up inflation.
What is about the financial?
Say that again. Who said what? What did you say?
A person who invests money, financial investor.
Yeah, but look, a professional, look, someone who just invests, I mean, average Joe can invest. Average Joe can invest, right? Because if he has, a retiree, most of the retirees, they have their money, their retirement, basically, all their retirement funds into stock market or some portfolio. So they would they would watch those, key indicators, economic indicators. But just because your next door neighbor is investing in some stocks, if you ask him, does he know exactly what inflation is? What inflation is between, obviously, what last year and this year? Does he know exactly? An average Joe cannot calculate inflation, because inflation, to calculate inflation, you have to have CPI data, and you have to calculate, and of course, an average Joe, if educated, trained, someone who has taken finance class, someone who has taken economics class, and did well in that class, yeah, as long as they can collect data, CPI data, consumer price index or whatever, they can calculate, right? But then not every average Joe. I mean, your next door neighbor, Mrs. Jones, can maybe in the stock market, put her money, some of her money in the stock, or in some stocks. But you ask, if she has no training, no education in finance and economics, do you think she knows, what inflation is? No way. Average Joe doesn't know. Some finance professionals would know. Financial professionals know. But again, you go to the bank, ask the teller at the window, so what is the real interest rate? What? They will say probably, what? And then you ask them, never mind, but do you know what the inflation is? 1 year inflation between last year, and they wouldn't know. They're just, just tellers. They just take deposit, they just mechanical things, they just do mechanical things, they just they just input the data into their terminal. That's it. They take deposit, just counting the money. The machine does that. They just input the data into their terminal. If you make withdrawal, they just take out the money from the vault and input the data into the terminal and just give the money out to you. That's it. They're not right. But the thing is, but do you know what inflation for 2021 is? Of course not, because 2021 hasn't ended, right? We know the inflation for 2020 because 2020 is over. We have the price data for 2019 and 2020. We can calculate it, but 2021 inflation, we don't know, because 2021 is not over yet, right? So in other words, what I'm saying is, inflation is not known for this year, for the current period, for the current year. Inflation for the current year is not known yet. So to calculate the real interest rate, right, for 2021, we'll have to wait until the end of 2021, and only at the beginning of 2022, when the data is available for 2021, then we can calculate we can tell what is the real interest rate. But anyway, we can do that for the past, right? For 2020, 2019, we can all do that. All right, everyone understands that? Everyone is following so far?
Yes.
Okay, thank you. At least one person is enthusiastic. What about the other people? Just, but the idea is, okay, we can find real interest rate by subtracting nominal interest rate from, subtracting inflation from nominal interest rate. Okay? So then you might wonder, oh, what is this all about? I mean, didn't we divide future value, right? The money in our bank account 1 year later, didn't we divide it by 1 plus inflation rate? Yes, but of course, look, we are talking about two different things. One, R, I, pi, they are all percentages. They are all rates. Okay, you understand? They are all rates. They are all percentages. So they can be subtracted, added to, they can be added or subtracted. You understand? They can be added or subtracted because they are all rates. Right?
Yes, Professor.
Right. They can be added or subtracted. But these are dollar values, not rates, not percentages, right? So this is a nominal dollar, right? Nominal dollar. And in the past, this is absolute nonsense. But some students are just nonsense. They are nonsensical. Some students, and this was in the exam. And the question was, what is the what is the real price in real dollars? What's the price in real dollars? Inflation was 10%. Price at time one is this, 1,010,000. Inflation is 10%. So what is its real value? Real, dollar value. And then the student was. What was he doing? He did, this minus 10%. Does that make sense? $1,010,000 minus 10%. First of all, can you subtract 10% from dollars? They are two different things. 10% is 0.1. I mean, if you're subtracting, first of all, stop. You're subtracting then, $0.1, 10 cents from 1,010,000. Or you would, if you're really subtracting it, then, you should be subtracting, 10% of, so that will be $101,000. But, the student was trying to subtract 10% from it, and he thinks he was subtracting 10 from it. 10, not 10%, 10 from it. He was thinking that he was thinking he could subtract 10 just because it is 10%. Look, we're talking about percentage here. We're talking about dollars. How can 10%, is 10% the same thing as $10? Huh? But that's a nonsense.
No.
But not that kind of nonsense. Some students are capable of such a nonsense. And what does that mean? That's complete lack of thinking. If you have ability to think, then this is weird. Can I subtract 10% from $1 million? How can I subtract 10% from one? They are two different things. It's like suppose you are 6'2". You are 6'2", and you weigh 100 and I'm sorry, you weigh 200 pounds. You are 6'2", and you weigh 200 pounds. And they say you are overweight. And you're not really overweight. If you're 6'2" and 200, I don't think you're overweight. That would look just right. If you're 6'2" and 200 pounds, you would look just right. But then let's say, oh, you should lose. Someone says you should lose 20 pounds, and then okay, if I lose 20, and it's like trying to subtract 20 pounds from 6'2". Do you understand? Huh? Trying to subtract 20 pounds from 6'2".
Yes, we understand.
These are two different units, and you cannot do that. Huh? But this kind of nonsense, some students were really capable of this kind of nonsense. But I hope none of you are like that. But this is the thing. So here, you can do this because real interest rate is nominal rate minus inflation, and you can add or subtract because they are all percentages. They are all, you can do that because they are all percentages, right? They are all percentages. You can do that. Now the thing is, although this is simply another expression of nominal rate equals or real interest rate plus inflation. But then what did I tell you? Although it's you're basically tweaking the same expression, but this is hardly possible. Why? Because you don't know this yet. This will be known. You don't know this yet. I mean, as I told you, we know this for the past, but for the current year, we don't know the inflation. So that means a real interest rate will be known only after we know the inflation. Does that make sense? Right? Nominal interest rate is already known because if you go to the bank and you want to put your $10,000 into CD, you know what interest rate they offer. They say 3%. Yeah, that's the nominal interest rate. But think about it. If the inflation was zero, right? Your real interest rate will still be 3%. Make sense? Everyone?
Yes.
Yeah, because there was no inflation. Your $10,000 will be able to buy 1,010,000 bottles of Coke. But let's think about it. What if nominal interest rate was 3%, but inflation was 5%? What if what's going to be your real interest rate? What's going to be your real interest rate? Huh? It will be exactly like the case of this, Coke, right? Inflation was rate. Your interest rate was 1%, but so actually I should use I here. This was nominal rate, but inflation was 10%. Then you have a loss of purchasing power. You have significant loss of purchasing power in your money, right? Make sense? Erosion of purchasing power. So what's going to be the real interest rate? If nominal interest rate is 3%, you go to the bank, the CD, but a year later you found out there was 5% inflation during the year. What is your real interest rate then? Anybody? Is this so? This is not a challenging question at all.
Professor, 8%?
Huh?
8%?
8%?
8%?
How can it be 8%?
Professor, is it 2%? Are you subtracting the percentages?
Yeah, I mean, yeah, of course. It's literally the math is obviously there. It's 3 minus 5. Then what is it?
2% then. Would it not be?
Why is it?
Negative 2?
Yeah,
Negative.
-2.
Negative 2?
-2. Who said -2? Who said -2?
Sophia.
Safia. Okay, Safia. Oh, Safia, you're on a roll. Yes, of course it's -2. You got another 0.25. It will be -2%. Real interest rate is -2%. And that's exactly what the math is, isn't it right? Then some of you may have a hard time understanding what is the meaning of negative interest rate. I mean, you're trying to wrap, you know, as the expression, try to wrap your head around it. Huh? What is? Think about it. Negative interest rate means, for example, if I lend money, right? If I lend money, and if the interest rate is 5%, right? If the interest rate is 5%, then I will, and there, if interest rate is 5%, then it's the interest that is being paid to me, isn't that right? I lended money, so the bank pays me 5% interest. That's 5%. But if the interest rate is -5%, what does that mean? If the interest rate is -5%, I'm lending the money, but instead of getting interest, I'm paying interest, 5% interest. That's negative interest. You understand? And you might wonder, how can that be? I don't understand. You're lending money. How can you pay interest? You should get, yes, you should be paid interest, but by lending money, you're paying interest. And as the borrower should pay interest, but if it is negative interest rate, then borrower is being paid interest. How is that possible? It is possible if it is like this. Think about it. Real interest rate, -2% real interest rate means what? I lended money, but because of loss in purchasing power, right? Because of 5% inflation, nominally I will get. So think about it. Just to make it simple, because it will be easier. If nominal interest rate is 10%, but the inflation was 15%, it will be easier to understand. Then real interest rate is 5%. What does that mean? So I put 10K as an example. I put 10K. This is principal. I put 10K in the bank, and 1 year later, I will have, because interest rate is 10%, I will have 11K, right? I will have 11K. But this is nominal dollar, right? Nominally, it is 11,000. I will just call it nom, right? Hard to write. Nominally 11K, but inflation was, there is 11K here, right? 10 with 10. But because inflation was 15%, my God, time. Real dollar value of this 11K. How do you make that adjustment? Remember, we did it like this, right? That's how you do it, right? Because inflation was 10% in this case, you divide it by 1.1, that you are making adjustment for that inflation. Huh? So you do the same thing, you make adjustments. So in real dollars, you divide that by, oh, give me a break, why? 11K.
11K minus 10K
What
divided.
minus? What minus? How do you minus what?
You say we have to divide. Or divide it. No, you say we have to subtract it, right?
Subtract? Subtract what?
Oh.
I even gave you that
Here.
example of a student who was trying to, that nonsense, doing the nonsense of subtracting percentage from dollars, and you're trying to do that? Huh? I gave you that anecdote, and you are still trying to. So what do? Inflation. This was how we made adjustment for inflation. So then, who's going to help me out here?
Do you divide it, Professor?
Yes, but divide by what?
Negative 5%.
Divide by negative 5%? Now think about it. If you divide by negative 5%, you divide anything by negative number, it will come out as negative number. Then you divide something by a negative number, it will come out as negative number.
So the only
What
other
does
positive
negative number
numbers
mean?
are 10%
Huh?
and 15%.
Say that again.
The only other positive numbers are 10% and 15%.
No, yeah, yes, of course, they are all positive numbers. 10% and 15% are all positive numbers, but 15% is inflation. Inflation is, of course, positive number, because that means if there's a 15% inflation, everything is 15% more expensive now. So that is positive number, of course, right?
So are we dividing by the 15%?
When inflation, look, if you divide by 15%, that will be, what do you think? It's going to be greater than 11K or less than 11K? If you divide by 15%, is it going to be greater than 11K or smaller than 11K?
Wouldn't it be greater?
It will be greater. Then if it is greater, what is the problem? I mean, if it is greater, that means there was no loss of purchasing power. Actually, purchasing power got much bigger. Think about it. You divide something by something, you divide something between 1 and 0. You divide any number by a number between 0 and 1. That will be greater than itself. Isn't that right? It's a common sense logic. If you divide any number by a number greater than 1, it will be smaller, right? If you divide any number by 1, it will be just itself. But if you divide any number by a number between 0 and 1, it will be greater, right? And you cannot divide anything by 0. That's not possible. That's undefined. And if you divide by a negative number, it will always be a negative number. So if you divide it by 15%, where did that come from? I mean, why do you think it is only 15%? Don't you get this logic? The logic is, look, let's go back to this simple example. Coke was $1 a year ago, right? But there was 10% inflation, so the Coke is, now $1.10, right? So if you want to adjust for inflation, if you want to adjust this for inflation, what do you need to do? Do you divide it by 10%? Do you divide this by 1.1 by 10%? Do you do this? Huh? Did someone
No.
drop a line in the chat box? Please, I can't see what's in the chat
I
box.
raised my
Don't
hand.
do
You
that.
divide it, don't you?
I raised my hand.
Huh? I'm sorry, what did you say?
I said I raised my hand. So we have to. Oh, sorry. So we would have to find the 15% of 11K and then divide that number by 11K.
You would have to do what? I'm sorry. You would have to do what?
Find out 15% of 11,000 and then divide that number.
Oh, 15% of 11,000.
Yeah.
No, actually, look, what, I don't know. I mean, it's a very simple thing. And I used also this example, right? There was 10% inflation, right? And you put $1 million in the bank, and the nominal interest rate was 1%, so you got 1,010,000. But since there was 10% inflation, you want to make adjustment for that 10% inflation. So what did you do? What did you have to do?
You divide
What
it.
did we do here?
You divide it
We divided.
by 10% or 1%.
Did we divide it by 10%? Does it look like 10%?
I don't know what you're looking at. I just see a bunch of numbers.
I'm looking at it. Don't you see the cursor?
The
We divided by
My cursor is
1.1.
moving around. Huh?
You're dividing by the 1%
We
then.
divided by the 1.1.
1%?
The 1.1.
1.1. So
divided by
what is
the
the
1 plus
1.1?
The
What is the
price of
1.1?
after the
The
inflation.
new cost.
Someone said?
The price of the Coke.
The
after
cost with the inflation.
Okay, someone said something plus inflation. What? What is that?
I said you divided the price of the Coke after the inflation.
The price of the Coke? No. I mean, okay. So this is no. This is not the price of Coke. I mean, you can. Why? Because if there's no dollar sign here. I mean, previously it was you divided by the price of Coke, but then if you divide it by price of Coke, then it should be dollar sign there. There should be dollar sign there, but there was no dollars. Instead of dollar sign.
The decimals, we said that it
Because,
increased
look,
by 110%.
if you listen. Yeah, someone said 110%. That's correct. Someone said who said that? Who said 110%?
Sophia.
Who said it? Huh? I didn't hear you. Safia, okay. Look, you gotta put into consideration that when our voices overlap, right? We happen to be speaking at the same time and our voices are overlapping, then obviously I can't hear you. Right?
It's a lag.
So-
It's not that we're speaking
so
at the same
when I-
time. You
when
just
I-
hear it after.
When voices are overlapping,
It's a
you
lag.
can't.
So after I finish talking is when you hear my voice.
Yeah, but the lag is very that wasn't definitive enough. So that's why I'm asking, what did you say? Who said that? What did you say? And if I say that, then just repeat it, right? Because if I'm saying, what did you say? Because of the vocal overlap, I couldn't hear you. So then that's why I'm saying, what did you say? Then you just repeat it. All righty, Safia, so you got another, I don't know if this was what I gave you already or you got another 0.25. Yeah, it's 110%. Look, yeah, maybe because first I divided by $1.10, then if you divide it by the new price of Coke, then what comes out is, you know, this is not dollars. I mean, think about it. You divide 1,010,000 by $1.10, then what comes out should be units, not dollars, right? 918,182 bottles of Coke, right? But then after that, I replace this by 1 plus inflation rate, 1 plus inflation. So then if you divide dollars by 1 plus inflation, then it will be dollars. You understand? Huh? So basically, what you need to do is you must, to make adjustment for inflation, you gotta divide this by what? You don't divide it. So what is it? Now you should be able to tell. To make adjustment for inflation, you divide this by 1.1. What is the inflation? What was the inflation in this new scenario? What is the inflation? Was it 10%? Was the inflation 10%? Look at, do you see the cursor? Do you see my cursor moving? That's real interest rate, nominal interest rate, inflation.
So the inflation is 15%.
15%, so you divide it by?
15.15.
15.15?
No, we said 0.15.
0.15?
115%.
1.15?
1.15, yes, 1.15. Okay, and someone said 115%. Yes, that's the same thing. 1.15 is 115% in percentage, isn't that right?
Why is
1.15.
it 1.15?
Why is it 1.15? And
Because you got your 10,000 back, and then you got another 1,000.
Okay.
yeah, look.
So it's always going to be 1 point, whatever the whatever the percentage is in terms of decimal, because you're adding 1 plus the pi.
Okay, that makes
So you're always adding 1.
That one is, yeah, that one is.
So
that
pi
one
right
is,
now is 15%. So it's
that one is
1.15.
That one is, that one is, the principle itself. Think about it. That one is principle itself. Remember this? Remember this? P1 is P0 times 1 plus pi. Okay? Why did we have 1 here? Why is there 1 there? Because we factored out. So think about it. You put 10K. You put 10K there in the bank. You put 10K, and with and inflation made everything 15% more expensive, right? The example I used here was 10% inflation, but if it was 15% inflation, if it was 15% inflation, everything is 15% more expensive, right? Everything will be 15% more expensive. So if you want to, if you adjust it by 1 point, so everything is, now Coke is $1.15. So if you want to adjust this price, nominal price for inflation, then you would have to divide it by 1.15. In other words, that 1 is because of factoring. You're factoring out because you factored out the common factor. You understand? So if you do this, right? And you can quickly calculate that.
9,565.
Someone did the calculation. Who did that?
9,565. Sophia.
Give me the number again.
9,565. Or if you're rounding it
Yeah,
because it says 0.21 at the end, you could do 9,566.
No, slow down. I'm trying to write down the number you were saying, so please slow down. 9,000.
Sorry. 565.217. So you can round it up.
0.5 what? 67. Yeah, that's fine.
217.
Whatever, let's
So
say
you can
just
round it up to 66.
yeah. Let's just put XX. Okay, 9,565. So think about it. What is the point here? We were, because of inflation, right? Nominally, 1 year later, nominally you have $11,000. Yes, that's $11,000. Obviously, nominally, you have in $100 bills. In $100 bills, you will have 110 of $100,000 bills. It's still $11,000, but in terms of purchasing power, its actual purchasing power, it's only worth 9,565. It can only buy what you could buy, what 9,565 could buy a year ago. You understand? So in other words, you lost money. Although you were paid interest of 10K, 10% interest rate, right? But actually you lost money. It's like from your original 10K, it's like you gave like $435 out as interest. Do you understand? Do you understand what I'm talking about?
Yes.
That's the meaning of negative interest rate. That's the meaning of negative real interest rate. Although nominally you got the 10% interest, so you have your interest is $1,000, right? So your future value is 11K nominally, but because inflation ate away, it ate into your inflation, ate into your future value, right? Actual in real dollars, in real purchasing power, it is only worth 9,565. That's what it can, that's purchasing power, right? That's the purchasing power. So it's almost like you lost from 1,000, your principal of 10,000, from your principal of 10,000, it's almost like you lost $435. You gave out $435 as interest. So this is what I'm saying. You are the lender, but because of inflation, you lost. Lender should be paid interest, but you are nominally paid interest nominally, but effectively you gave interest. So then who got this interest? The borrower. Think about it. Think about it. 1 year later, who's the borrower here? Who's the borrower? You put this money where? You put this $10,000 where?
The bank.
In the bank.
Yeah, in the bank. The bank is the borrower. 1 year later, the bank will pay you. If you withdraw money, the bank will have to pay you $11,000 in nominal dollars. But what they pay you is actually that $11,000 is no longer actually worth $11,000 in purchasing power, right? In real purchasing power, it is only worth $9,565 in real purchasing power. So the borrower, the bank, is actually paying you out. It's if they are effectively paying you out $9,565. You understand? Although nominally they are paying out $11,000, they are paying effectively, it's like, so the bank, in other words, paying out 11K is a huge burden if there was no inflation, right? Paying out 11,000 is a burden if there was no inflation. But with inflation, the burden is lighter. It's lightened up. The burden is lightened. You understand? The burden, you have lighter burden of paying back. Does that make sense, everyone? Because bank is effectively, it's like paying, in real purchasing power, it's like paying 9,565. Does that make sense?
Yes.
No? Yes. And okay, before I move on, there was someone who said, dividing by 115%. Who said that? Oh, there was a gentleman who said divide by 115%. Who said that? Who was it?
What was that, Professor?
I don't know if it was you or there was a guy who said, when we were talking about dividing by this, you said, someone said divided by 115%. There was a I think Safia said divided by 1.15, but right before that, a guy said divided by 115%. Who was that?
Me. 100%.
Who was that?
Jiquan.
Jiquan. Okay, Jiquan. So I'm trying to give you the credit for your good deed. So, make sure you get the credit. I try to give credit to where credit is due. So make sure you get that credit. Okay, Jiquan, you got 0.25 for that. All righty. So everyone understands now the meaning of negative real interest rate. Okay. So negative real interest rate is a very interesting thing, because think about it. In reality, all you see is, actually what you can see is only the nominal interest rate, and the nominal interest rate can never be negative. Nominal interest rate can never be negative, because who's going to lend money if the interest rate is negative? Nobody. But European Union has experimented with negative nominal interest rate. European Union. I think it was Sweden, or what was that? Sweden is not part of European Union. Some country in the European Union. I think it was Sweden. But nominal interest rate, because nobody lends money if nominal interest rate is, and real interest rate turning negative, it's accidental. It turns negative only because inflation was bigger than nominal interest rate. Make sense? So nobody intends, but sometimes this is intended. Why? Let's think about it.
So the banks earn money? Because technically you're paying them.
Yeah, exactly.
I said I would assume that the opposite of banks earn money.
If you're the borrower, right? If you're the lender, you don't like negative real interest rate. But if you're the borrower, oh, this is a good news, isn't that right? This is a wonderful news, right? Why? Because you didn't know the interest rate, real interest rate would turn negative. But years ago you borrowed $1 million. 10 years ago you borrowed $1 million. Now it is 10 years. So this year you have to pay back $1.1 million. Interest rate was, nominal rate was 10%. So now you have to pay back 1.1 million. But then what happened? between last year and this year, inflation has been, or between last year and this year, or between 10 years ago and now, inflation has been 15%. Inflation has been 15%. What does that mean? Although you borrowed 1 million and paying back 1.1 million in nominal dollars, but you are actually paying back only like 9,000 something. I mean, much less than what you originally owed. Right? Does that make sense? So isn't this a good news for the borrowers? And also, if this can be anticipated, you would increase borrowing now, because let's say if you can forecast that 1 year later inflation will be 15%, and your borrowing at 10% or 5%, right? You're borrowing at 5% or at 10%, but you can forecast that the inflation will be 15% 1 year later. This is the time to borrow, right? As much as you can. And 1 year later, you pay back. Nominally, you will pay 1.1 million, but with 15% inflation, you're paying back much less than what you. So, why is this important? Why? I mean, good news for the borrowers. Why is this a big deal? I mean, why? You might think. Good news for the borrower doesn't, people then, business, it's not people, but, mostly businesses. Businesses increase borrowing when, real interest rate is negative. And if it isn't anticipated, if negative real interest rate is anticipated, then they increase borrowing. By borrowing, what do the businesses do? We've been talking about this. Businesses don't borrow for fun. Businesses don't borrow to have party.
So they can expand.
Right? Don't borrow to throw office party or to, lavish, to have lavish
So
lifestyle.
they can expand.
Say that again?
So that they can expand.
What? Yeah, they invest. They invest on their capacity expansion, right? So what does that mean? When they borrow money and increase borrowing and expand their capacity, that means the plant production capacity of the plant will increase, and it will hire more labor, more workers, right? It will use more equipment. It will hire more equipment. It will use more electricity and more raw material. Look, there is a positive feedback. There's a positive feedback into the economy. So the economy then grows. Economy expands. Right? So negative real interest rate is not a bad thing. Negative real interest rate is a good thing for the economy, actually. Does that make sense? So they may, now, look. At the beginning I said, it's already 7:50. I have a lot more to say about this, but I'll have to move on because this is, now, so it's 7:50, I can't, this is the classical theory about the structure of interest rate. So let's say we know, the interest rate is basically, nominal interest rate is basically real rate plus inflation, or real interest rate is equal to nominal interest rate minus inflation. But let's take a look. Another notation, another symbol for interest rate is K. And K is actually a very broad concept. It's a very broad concept. Why? Because it stands for cost of capital. And what is cost of capital? Cost of capital means exactly, what did I say interest rate is? I mean, interest rate is price for borrowing, isn't that right? Isn't that right? We talked about this. Interest rate is basically price of borrowing, right? Price for borrowing. So think about it. Cost of capital means it's the cost for raising capital, right? Cost of capital, that means exactly cost of borrowing, cost of raising capital. Make sense? So that's another name for interest rate. But then the structure of interest rate is it's basically a base rate plus risk premium. And what is the base rate? Base rate is a pure rate, right? K pure is pure interest rate. And then plus inflation adjustment for inflation. Okay. So in other words, I told you, you don't know pi, you don't know inflation until the year is over, right? So when they set nominal base rate, because they don't know. I mean, if I'm setting the nominal interest rate for base rate for 2022, I don't know the inflation for 2022 yet, but I can make a forecast. Forecast is based on the past inflation data, right? Like past 5-year inflation, you take the average of that, just simple average, not geometric average or weighted average. Simple average of the past 5-year inflation, and you use it as an estimate. It's an estimate. What this E means, that's called expectations operator. So that means expected inflation. You'll have to, using the estimate from, which is the simple average of the last 5 years or last 10 years inflation, most of the time last 5 years. So I'll have to make a basically a estimate or forecast of the base rate that way. Now, so this looks like R plus pi, right? R plus pi. So this is nominal rate I, but that's not all. Because we have other than inflation. Inflation is a kind of risk. What is that? What is inflation? What is inflation? Inflation is a loss of purchasing power. Isn't that right? Inflation is the risk of losing purchasing power. But that's not the only risk. Think about it. So pure interest rate or real interest rate is the real earnings power of money. That's what exists in the real world if there is no inflation. And it's generally between 2 to 4%. Inflation adjustment, average, right? Annual inflation over, like past 5 years. But beyond that, there are 3 types of risks. 1, default risk. 2, liquidity risk. 3, maturity risk. Default risk, liquidity risk, maturity risk. Default risk is quite obvious. And we talked about this. When you're lending money, what are you most concerned about? What are you most concerned about when you're lending money?
You won't get your money back.
Yeah. You're concerned, you're worried, you're concerned about, not getting your money back. So in other words, your borrower defaulting, you're concerned about your borrower defaulting. That is the greatest risk. But again, I told you, in the bond market, you can limit your risk exposure because if you don't want to take any risk, you can limit your lending only to the highest quality borrower with, like, AAA credit rating. If you're lending to a person, you look at his or her credit score, and you lend to the people with only like 820 credit score or above. You have peace in mind, right? But anyway, but safe borrowers, riskless borrowers, low risk borrowers don't have to pay high interest, so it's not very interesting. You understand? It's not, if your interest you get is very low, that's not very interesting. But anyway, then there's liquidity risk. What is liquidity risk? Let me go to liquidity risk, default risk. Okay. Liquidity risk is, what is liquidity? First of all, we have to discuss what liquidity is, and the liquidity means, yeah, how easily you can convert any financial asset into cash. So stocks are very liquid assets. Of course, stocks of unknown companies. So what are unknown companies? I mean, if the over-the-counter market, in other words, penny stocks. Penny stocks are not listed in the stock exchange. Penny stocks are traded, outside the stock exchange, and the companies are not very pretty much unknown, and you are not. And think about it. If it is not stock but bond, are you willing to hold? Are you willing to hold the bonds, or invest in the bonds, buy the bonds of an unknown company? Huh? Are you, if it is an unknown company, yeah, you're very reluctant, right? Because, think about it. Buy any, because you cannot, okay, there's some background noise. I don't know, someone's playing harmonica. Please, mute your microphone, please. So, the bond of an unknown company is illiquid, meaning it's not easy to sell, and obviously, to buy such a bond, there should be risk premium. In other words, bond of such a company will have to pay higher return, higher coupon rate, right? It must pay a higher coupon rate to be attractive or to sell. You understand? To be marketable. So that's the risk premium. There should be risk premium for liquidity risk. And then maturity risk. Which one has more risk, between the short-term bond and long-term bond? You understand, short-term bond, they are called, commercial paper. I mean, if it is a corporate bond, short-term bonds, short-term has, maturity under 1 year, right? So, short-term bond, between short-term bond and long-term bond, with maturity above 1 year, up to 30 years, between the two, I mean, between a 30-year bond and 1 year bond, less than one, like 60 days or 90 days, 30 days. But let's say 1 year bond and 30-year bond. Which one is riskier? Which one do you think is riskier? Huh?
30-year, because it's longer, so more changes can happen.
Of course. Yes, of course. Yes, of course. The longer the maturity, the more the uncertainty. Isn't that right? the more the uncertainty. And the uncertainty is, I mean, future is always uncertainty. I mean, 1 year, 1 year into the future, it's relatively safer than 30 years into the future, because at least within 1 year, I mean, within 30 days, 30-day maturity, nothing drastic will happen. Nothing drastic will happen, right? Pretty much everything is predicted. Within 1 year, pretty much everything is, predictable. And it's 1 year. You just wait one year and you get your money back. But if it is like, 30 years, you don't get your money back until 30 years. Of course, you can sell it. I mean, I told you there's a second primary market and secondary market. You can sell it. I mean, you can hold it for 1 year and sell it to another buyer. The buyer can buy it from you and hold it for 3 years and sell it again. In other words, financial assets are traded. That's one good thing about financial assets. You don't hold that risk forever. If you don't like to hold it, you can trade it, right? It's being traded. That's why it's financial. There's financial market, and financial assets are changing hands. Financial assets change hands. Make sense? You understand? But anyway, anyone holding a 30-year bond is facing a lot of uncertainty, and uncertainty is a great risk. A great risk, right? Because we never know over the 10-year life of this bond what's going to happen. Over 30-year life of this bond, what's going to happen? There might be recession. There can be a huge inflation, and then interest rate might just go up like drastically, or there can be a war, there can be a pandemic, or anything. There's a lot of uncertainty with long-term maturity, right? So obviously, long-term bonds must pay higher interest than the short-term bond. And you might wonder, yeah, isn't it obvious? I mean, 30-year holding period, 30-year holding period return must be greater than 1 year holding period. 30-year holding period return must be greater than just 1 year holding period return. No, I'm not talking about holding period return, because you can't compare 30-year holding period with 1 year holding period return. They are not on level playing field. You can't compare like that, right? Understand? But clearly, if 30-year holding period return must be greater than just 1 year holding period, or 1 year HPR, right? But then think about it. When you are trying to compare two things that have different maturity, what do you need? What do you do? That's where that annualized return come into play. You compare the annualized return, and what I'm talking about is annualized return. I mean, annual interest rate of long-term bond is greater than annual coupon interest of 1 year bond. Does that make sense? Annual coupon rate of 30-year bond or long-term bond must be greater than annual coupon rate of the short-term bond. That has to be. It has to be, right? Because otherwise, there is no incentive for people to put money into something riskier, right? That's maturity risk. So eventually, the structure of the cost of capital or interest rate it can break down like this: pure rate of return, which is real interest rate, plus inflation adjustment. So this is the risk premium for actually purchasing power, loss of purchasing power. Inflation adjustment is the risk premium for. So, but then this is base rate, right? KPR plus pure return plus inflation is the base interest rate, and then there's default risk premium, liquidity risk premium, and maturity risk premium. Okay, That is the theoretical structure of the interest rate. Okay. Now, we still have the next thing we have to talk about is the yield curve, but we are out of time. So we'll have to call it a day here. I'll have to